Gold is everywhere right now. Everywhere you look, news headlines, YouTube thumbnails, social media posts, gold is hitting record highs again and again. And that brings up one very big question. Is this massive rise in gold about to end in a crash? That's exactly what we're going to talk about today. No hype, no fear-mongering, just calm, logical thinking. So stay with me till the end because this topic is often misunderstood. Here's where we are right now. Let's first understand what is actually happening. If you look at the one-year chart of gold, something incredible stands out. In 2025 alone, gold went up around 64%. That's not normal. That's huge. Now, just for comparison, the S&P 500, which represents the U.S. stock market, went up only 16% in the same year. So clearly, gold didn't just perform well. Gold massively outperformed stocks. And when you look at the one-year chart, the rise looks smooth, steady, and calm. Nothing crazy, nothing scary. At least, not at first glance. Now, let's zoom out. But here's where emotions kick in. When we zoom out and look at the 30-year chart of gold, suddenly the picture changes. The rise looks very steep, very fast, very aggressive, and honestly, to most people, it looks scary. It feels like this can't keep going forever, right? And that fear is natural. So now, let's go even further back. The 50-year view and the biggest gold crash. The most famous gold crash started around 1980. Let's understand what really happened back then. During the 1970s, the world was a mess. Inflation was out of control, oil prices were exploding, wars and geopolitical tensions were everywhere. People were losing faith in the US dollar. Gold became the safe place. As fear grew, gold kept rising, slowly at first, then faster and faster. By January 1980, gold hit around $850 per ounce. Then something dramatic happened. Gold collapsed nearly 65%. And this is where most people get it wrong. Gold does not fall just because it's expensive. This is very important. Gold does not fall just because the price is high. Gold falls when confidence in paper money returns. That's the key idea most people miss. So let's talk about why confidence returned in 1980. What the Fed did in 1980, the Volcker shock. By the late 1970s, inflation wasn't just high, it was out of control. People didn't trust the Federal Reserve anymore. Markets believed the Fed would not do what was necessary to stop inflation. Then came Paul Volcker, and he did something almost impossible to imagine today. Instead of slowly raising interest rates, he pushed them up to nearly 20%. Yes, 20%. Just imagine that. Home mortgages at 18%, business loans extremely expensive, borrowing almost impossible. Some people watching this video don't need imagination. They lived through it, and it was painful. Real interest rates changed everything. Here's the most important part. Rates were pushed higher than inflation. That created positive real interest rates. For the first time in years, saving money paid you real returns. Holding money made sense again. You didn't need gold just to protect yourself. People stopped running from the dollar. Confidence returned. The US dollar became strong again. Global money flowed back into US assets. The price of credibility. But this came at a huge cost. Recessions, high unemployment, asset prices crashing, massive economic pain. The Fed accepted this pain to restore trust. And once trust came back, gold's job was done. Gold didn't crash.